Three, two, one. All right, let's go. Hello, everyone, and welcome back to another episode of Trading WTF. We took a couple weeks off, but now we're back online, and excited to be speaking with everyone and sharing knowledge about the markets and what's going on around the world. In this episode today, we have Teddy Kekstadt with us. Teddy has over 30 years of trading experience. He is a veteran of Forex, futures, stocks, options, and binary options. He has over 20 years of trading floor experience at the CBOE, CME, and CBOT. It's a lot of initials over there. If you have any questions, we can ask Teddy or we can Google them. He earned a degree in finance from DePaul University in Chicago. Teddy is the president of Forex Trading Unlocked, an online trading hub, which hopefully he'll tell us more about. In 2016, Teddy published his book, High Probable Japanese Candlestick Patterns. And I know everybody on TradingView who's looking at those charts is going to be excited for this episode. So in this episode of Trading WTF, we're going to be talking to the trader, author, and educator. And we're going to look at some of the major events that are coming around up in the markets and around the world in the coming days, weeks, and months. Anything you'd like to add to your introduction, Teddy?
No, I think you hit it all. That was great. Thank you, Michael.
Oh, sweet. All right. Thank you. All right, let's jump into it then. Maybe we could give the audience some background about how you started your career in trading and financial markets.
Okay, well, after I graduated high school, I started working at the CBOE the summer in between high school and college, and I was going to school in Chicago as well. And it was because it was a major city, and they also had a lot of people that were in the business community and trading community. They worked with the exchanges. That was one of the reasons why I went there. I was able to go to school at night, so I could work during the day on the trading floor. So I started in the summer of '89 at the CBOE. But I wanted to be in the futures business. I didn't want to just be in the options. In the board of trade and the bond pit was actually what I originally wanted to go to. But my opportunity to get into the futures industry about 4 to 5 months later was when I got the heads up that I could get into the CME. And then I started in January of 90 in the S&P 500 pit. So, and then I stayed at pretty much from my tenure on the trading floor at the CME until they bought the Board of Trade and they merged in the early 2000s.
What's it like being on a trading floor? For anybody who's stuck behind their computer at home.
You tell you what, it's nothing like the movies. They can't even begin to, think about this. Like if you didn't ever leave high school, think about after like 10, 20 years, you know everybody there to begin with. Think about a place where when you go to work that over 1,000 people say hi to you and good morning to you during the course of a day, even if you're not even working with them. Like that ability to be connected in a community so deep, over time, and under, a lot of stresses and stuff, you get to know people, when you're on the trading floor for like 10, 15 years, people there better than some of your people you went to school with, your family, you spend more time with them because you're with them 8 hours a day. Because I was in the S&Ps, which was a long market trading day. I wasn't in the meets, which was 4 hours a day, which was just only 100 yards away from our pit. So, and they would start after we opened and they would leave before we were closed every day, so we were very jealous of them, so.
Yeah, when you're in the trenches, and I think those definitely are the trenches. When you're in the trenches together, that's where bonds are certainly built. And I guess, you have a community, and how would trenches be built for traders at home, sitting back here?
Well, you know what? Over time, relationships are built no matter what. The one nice thing about the trading community is that people do. It's a community of communication for business, because the markets are something that no matter whether you're a player in the markets or not, the markets are a biorhythm of what's going on in the world, depending on which biorhythm you're looking at, So, and especially, I remember when the electronic trading first started, I evolved out of that. I was there when it first began, and even that was limited, now it's 24 hours for the most part, especially with cryptocurrencies. It never sleeps, right? So, and the one thing I've noticed that when people migrated from the trading floor is that even though you didn't come into work and see each other, first they had the offices and they were in the building still, and sometimes they were in other high rises or even in the suburbs, and trading rooms just evolved, Now you don't have those so much because of the technology, people look at the pandemic, how it's impacted their lives and businesses. In 2020, I had friends of mine, they're like, well, how is your life impacted? I'm like, well, I've been trading off the floor for over a decade at least, for one, and I'm like, I do everything remotely. I'm like, I don't go to a trading room. I'm like, I used to do that stuff, but then it's like, you start realizing you don't need to because of technology. So you get to have parts of your life now that you didn't have, because your life revolved around getting up super early, commuting to a place to do business, and you're there all day long. And then, then there's the after effect, like in the S&Ps, like I remember when the first Gulf War broke out, I mean, every single day we'd be there for 2-3 hours after the settlement of the S&Ps, trying to figure out to make sure that we didn't have a problem. I mean, you were talking about millions of dollars were on just one trade for one brokerage house at a time would be at risk, so those were interesting times. It was different, but now the communities, because of technology, like we didn't have the ability to communicate with so many people at once, so whereas now is like the whole community can actually be hubbed together, whereas before we were in different buildings or you had some sort of, edge on communications before from the floor, but you can do things now with the technology you couldn't do before, like for instance, like we're having this conversation today where, people can watch CNBC and other news sources and stuff. But this is something this is a niche part of finance. You didn't have the ability to have like a place to hone into where the whole community can see what we're talking about live, as the markets are going, while they're trading, these are things that I think it's very good for the new environment. I mean, do I miss the camaraderie and stuff like that? Absolutely. But I don't miss the stress. I mean, I probably, if I would have still have been on the trading floor for the last 10 years, I probably look 20 years older than I do right now. So I mean, I think, I mean, that's part of life, which I love trading, but to be quite honest with you, I mean, it was exhausting. I mean, you wouldn't believe when you're running on adrenaline all day long, and it's a fist fight too. Like you think, I mean, it doesn't matter how big or small you are, man or woman, like when you're in the pits, and no matter what, whether you're on the desks or in the actual center of the pit, it's no joke. It's physical, and it wears on you mentally and physically, whereas now trading, it's a mental game. It's definitely a psychological, whatever, but you don't have that other physical part draining you at the same time, so I think in some ways it's healthier. Do I think it's better necessarily? No, I think they both have their, strengths and weaknesses. So.
Yeah, and I guess with all the adrenaline, stress, and whatnot, if only they had Red Bull back then in 1990, right?
Oh, believe me, they are people with all the coffee and believe me, other substitutes. Red Bull is nothing. So we could have an episode on stories like that if you want. The after-hour stories of the trading floor. So I mean, everyone knows that. That's the one part about the movies. They kind of get right, like without a doubt. You would be surprised where, I mean, we call the regular public were civilians because they just can't hang out with that crowd. It's just not for very long. Yeah.
It's got to be a whole other type of beast, right?
Right. Yeah. Absolutely. So.
Well, I guess we kind of explored how trading has changed since the start. I guess, since you began as a commodity trader, how did you get interested in the currency markets and trading over there?
Well, what it was really was once I was on the floor, when you're in the different pits, they got boards everywhere, and like you could see what's going on in different markets. Now, especially when I was in the S&Ps, I'm like, we watched the bonds and the bonds watched us. It's kind of like a normal thing that you do. But then there was the currencies and other markets and other global equities and what have you. And you could see like what the DAX is doing and the Bund is doing, and what the, obviously at that time there was only 5 currencies traded at the Merc, all the major crosses, not like in the Forex markets now where you can trade every derivative of almost every cross, versus other currencies. So, but when I was in the pits, and I would notice how, as I was studying markets and learning how to analyze them and things like that, and the interrelationships of markets, most traders focus only on one market. And it doesn't matter whether it's S&Ps, whether it's the treasury bonds, whether it's the Deutschmark, which doesn't exist anymore. I mean, well, it actually physically still does. Most people don't know that. But now it's the euro, or the yen, but they only focused on that. And I remember on the trading floor as a kid, it was early 20s, and I would ask other traders from like the yen, the currencies, or the euro dollar pit, which is not the euro dollar currency, it's the euro dollar future interest rate product. And I would ask them, I'm like, what do you look at? And they're like, well, I just watch this and this. I'm like, well, how come you don't watch the currencies and you don't watch the this and that? And they're like, well, why? And the reality is that there is an ebb and flow of cycles of markets. For instance, like, there's the gold market, there's the interest rate market, and there's the equity markets, and they all ebb and flow in a rhythm, when they start to set trends. No matter what, on the long-term basis, they do influence each other, And another thing that there's a variance of that is the currency market. And that's why I would say, it's kind of funny, like when you talk about gamblers, they understand this. Watch where the big money is. Like if you watch horse bettors, they'll watch the tote board right before the last couple minutes before a horse race goes off to see where the big money, how the odds swing. Where's the big money going? Okay. And you can track that just like you can do that with options. And the other best way to do it is with currencies, because currencies trend. See, most markets only trend 30% of the time. 70% of the time, they're just gibberish. They're just gyrating, Yeah. So, and then when you look at currencies, though, it's the opposite, And so that is an influencing factor that you can use that variable to put yourself in a higher probable situation of success, because I learned, like, it's kind of funny. You would see pit traders, especially market makers, come and go. And then I saw these guys, some of the option spreaders, because most option traders are not outright traders, they're spreaders, and then a lot of the guys from the meets.
What does a spreader mean?
A spreader is someone who either, for instance, if you're in the futures, you have different expiration months. So you can trade different months of the same contract. So you may be long the June and short the Dece, just like, for instance, with options markets, how you have different expiration months for any different product, okay? So when you have that gives you different arbitrage opportunities and abilities to read where the market's actually going and where the money is, So you can tell, at times where the trend is being reinforced and where it's not, and spreaders, for instance, they would put on these positions like, for instance, an outright trader would have on like, 5 euros or 5 yen contracts, whatever, let's say. A spread trader will have like 10 times that, because the risk is not that big when you put on spreads. Okay, so and but the thing is they move over time. They move really slowly, and then you catch trends that way. And the reality is that trend trading is how you make your money. You make your money on the action, not on the reaction. And the problem is most people, especially new traders, try and pick tops and bottoms. Dumbest thing in the world to do. The biggest thing is to always identify a trend and try and ride that trend. So you look for buying dips in rallying markets and selling rallies in breaking markets. And the reality too is that in bear markets, you have the biggest rallies in bear markets and you have the biggest slides in bull markets, So, and these are things that most people, they don't use that to their advantage. And spread traders, that taught me that, especially with currencies, you can catch the trends, where you may get nibbled in and out because of your risk levels, your thresholds when you buy into or short into a currency market. But if you're riding the trend, the overall direction of the trend, typically you get in a good area where, as long as you have good money management principles, you can catch that trend, So, and that's really what drew me to the currencies, was your ability to not avoid all that chop, because when you go, if you get chopped up, unless you see, range traders do well in choppy markets, but they get slaughtered in trending markets, So, but if you make all your, like, let's say you catch a nice move, lots of traders, especially new traders, they catch a nice move, they make a nice little boost in their account, they got a nice big chunk, they're like, oh my God, I doubled or tripled my account. They start raising their size too quickly right off the bat. And then all of a sudden they get into the chop zone. So all of a sudden they're getting long and short. And all of a sudden after 2 weeks, they're like, if I would have just stayed long or stayed short instead of bouncing around constantly, then your account doesn't go down in value. You maintain your balance, and that's the big thing, is money management is the key to success in trading, and if you don't put yourself in these certain perspectives, to put yourself in that right mindset, you're going to make mistakes that are just going to chew you up, and it's going to erode your capital no matter what over time.
We got a couple of questions coming in, and
Great.
Well, based on what you said, riding the trend, if trend was a horse, I would definitely be kicked off of that horse enough times. I wish I could ride that. Wish I could ride that horse. So, any tips for spotting trends, and then
absolutely,
and then how do you stay in it? How do you stay in it instead of, like you said, you look back, you're like, oh, if I was on the right thing, if I just had the patience. How do you how do you deal with yourself and then manage the trade?
I got a great example that people can relate to into what's going on right now, and I believe it's a topic we were going to talk about, which is oil. Okay, so let's go backwards to January 1st. Okay, and I'm not getting on a political stage here or anything, but you have to look at certain things that will occur. Okay, so on January 20th, there was a mandate that screwed up our whole oil sector. So that alone, no matter what. Now, this is back when oil was at $25, $30 a barrel. Now, it doesn't take a rocket scientist to know that if we're going to go from a net exporter to net importer, the price of oil is going up, no matter what in this country, let alone globally. So when you look at the fact that you already know there's a commodity trend emerging, then you look to the currencies that are impacted by oil. See, most people, this gets back to what I told you before about why you look at other markets. Like when I was in the S&Ps, I'd be like, look at what's going on with the bond and the DAX, and also look what's going on over here. Like, why are you looking at that? Well, here's why I'm looking at it. If oil is going higher, that means that the US dollar yen, even if it's in a bear market, will become neutral to a bull. Why? Because Japan is oil dependent. They're also one of our allies, with us no longer being a net exporter and Japan being one of the countries that we were exporting to. That drives up the cost of oil in Japan. It also puts a strain on our relationship, which means that the US dollar yen, most people would think that would be bearish. Well, no, that's bullish, because we still produce oil. Even if oil gets really expensive, we still have it. It doesn't it puts a strain on our country, but it doesn't put a drain on it. So then you know that right there, for just that relationship, for that currency cross, that you have a bullish factor for the US dollar. Even if the US dollar is a bear against every single currency in the world, this one relationship would be neutral to bullish because of that. So when you take that, and then you add, for instance, the 30-year and the 10-year notes, okay, where just for the viewers that aren't familiar, if bonds and notes, meaning interest rate products, go up in price, interest rates go down. If they go down in price, interest rates go up. So now if you couple a rallying oil market and then a breaking 30-year and 10-year market, because interest rates are definitely a function of currency pricing. So if interest rates are going up in the US, even if the Fed doesn't do it, but they are by the market rate, and oil is going up at the same time, that means that the value of the yen versus the dollar is being lessened just by those two other markets. So that means you can look to get long the US dollar yen, and then when it rallies, you can look to take profits, or you can raise your stops, and then when you do have a big sell-off, you look for you want a correction, so then it gives you a reason to wait for a good buy signal to get long if you weren't in beforehand, and then you can catch those trends. You see what I'm saying? So those are factors. And you know how most people look at indicators? All indicators are lagging. I always tell people the best indicator out there, period, is always the markets, because it's in real time, no matter what. I mean, there's always sometimes spikes in any given moment in like a microsecond in a day, but over days and weeks for sure, those trends and whatever, that is solid, and that you can count on, and you can integrate those as those indicators, and that gives you an idea about trends. You know, the same thing is the converse for the U.S. dollar, Canadian dollar. In the United States, as of January 20th now, we're importing Canadian oil instead of just letting it flow through our country. Now, the U.S. dollar Canada has been in a bear market for, basically a year. We've had a nice upside correction, but now with oil spiking up towards 80 again, and with the fact that we're importing now more, there's a demand for more Canadian oil. Well, that means the U.S. dollar Canada is getting back towards where it's looking to sell off and probably head lower once again and maintain the overall monthly trend. So does that seem kind of clear? Does that make sense? Did I break it down?
Yeah. Oh, yeah. Well, good old Keystone. Where's that? Well, that's a different day, right?
Right.
Canada building those pipelines. But yeah, we're seeing shortages all over the world right now. So it's interesting. They say they'll be corrected at some point next year, but hopefully that gets better. So it's definitely interesting seeing how everything is connected in that respect. And I guess the other part of the question was, how does someone stay in the trend? Or what are some things like staying in a trend? I battle myself. So some of the things I battle on staying in trend is, it's trending, but you just wanted to lock in profit. And maybe I didn't have a good enough plan to say, okay, I'm going to stay in here right then. Like, is there a plan or a way that someone can say, I'm going to ride this? Yeah.
Absolutely. Well, that's right there. As far as a plan, you should always have a plan before getting in the market, and I think that's one of the, and this is something I remember from the trading floor days. And the worst thing that happens is when people are doing really well, they tend to exacerbate stupid behavior, because it doesn't cost anything to them, at least in the short run. They don't think so. Trading is not gambling. So whenever you put on a trade, first of all, it doesn't matter whether you're right or wrong. You need to know what your risk level is. No matter what, you have to have a risk, an entry price and a risk level of where you're getting out. You have to be secure in knowing that on any given trade, whatever market you're trading. Then you also do need to have a profit objective. Like I always tell people, like, especially get people who, especially who aren't really investors or traders, but, anyone can, it seems like they're a genius when they get long a very good big bull market, and anyone that bought Tesla a couple of years ago or Amazon thinks that they're Warren Buffett, I mean, well, that's not the case. You know what I mean? So, and this, for instance, let's say today, like the U.S. dollar yen, like we're talking about, I've been long the U.S. dollar yen for months. I've taken profits out of different swings. Some of them I've actually chopped up a little bit, but I've been net long. It's been a creeping 16 before the end of the year, possibly at 122 if oil gets back above, if it gets up to 95 bucks a barrel, and especially if rates go down. So the longer part of my position, once it gets to 116, which is my initial objective from months ago, I'm going to eliminate a big portion of my initial position. Now, along the way, when there's been sell-offs, I've waited for buy signals. My book, High Probable Japanese Candlestick Patterns, irony of it all, you actually have Japanese candlestick patterns that happen in the U.S. dollar yen, right? Who knew? And then when those occur, for those individual trades, I will add on. So I already have a net long position that I'm riding the trend, so I'm not worried about that. I do have a rising risk level that if the market does sell off, I take a profit. I'm not screwed on that one. I've made some money. But the new ones I put on, I know have a new risk level that's just for that trade. And I also have a profit objective. Now, usually I don't put it on a trade that doesn't have at least a 2-to-1 reward to risk ratio. Usually I look more of a 3 to 5 to 1 reward to risk ratio. This is my rationale, and there's math behind this that I even have in my book. It explains that when you lose money, you have to make more than you lost, obviously, just to get back to where you were. And that's one thing that's, I think, pretty obvious to everybody. What isn't obvious is how you position that money, So it's a matter of like, how much do you risk at a time per trade? How much do you have at risk on your account at any one given time? These are things that you have to maintain. So that will dictate how much I will add in this new position. And then I know that, for instance, like the markets in the yen's trading like around a 110, whatever, 111, whatever. Let's say I have a 110 half buy order. I'm risking down to 110 on the trade. That means I'm looking to get up to 111 half to 112. And then for sure, that's my ultimate target. And once it gets there, I'm out of that trade. That part of the position, I'm not growing my overall longer term trade. And this is where traders really get hurt the most. They're in a trend, they actually catch a trend, and now they're up money. So now all of a sudden they see, oh, well, I have all this profit. Now I can add to this trade. And I'm not saying that you shouldn't add to a trend or a trade. However, trends do eventually turn. And you realize that when you're up, it's one thing to take out your initial money and then be playing with house money. But if you're adding from your profits that you haven't realized, and then what you're doing then is you're cannonballing potential winner into a loser. And then all of a sudden what you had diminishes really quickly. So that's a mismanagement that most traders get into. And that's why to your question is, if you have an overall plan like I do to go to 116 on my overall long, but any interim trade, when they get to those targets, I'm done. And then that capital is back into the pool and into my account waiting for the next trade. So that's how I manage it. And that's what I tell people. That's from experience. That way gives you a better survival rate. The other way will typically put you in situations where you'll take really big hits.
What you said, once you lose some money, you got to, fight to make it back. We had a client or a trader, let's just say they lost 90% of their funds, and right now they're about 75% of the deposit amount, and we're like, if only they just started with 10% of their account, they would have made 777%, but they have to make over 1,000% to get back to break even.
Exactly. You got it right there. And I have that. That's what I explain in my book. You are 100%. That's what you need to do. And that's not easy.
No. But watching that miraculous comeback is incredible. It's like, okay, now once they get to break even, let's see if they can, make if they can make 700% again. Like, those are phenomenal returns. It's just, what kind of risk are they taking? And why did they have to go for that ride?
Those are phenomenal returns in the short run, but are they sustainable? Believe me, I've seen, and this actually gets to what can you pull yourself out of this? When I was on the trading floor, there were a lot of really big traders. Then all of a sudden, they would end up being upside down like $5-10 million. Well, what do? Well, you got some people who bail you out. Okay, they're like, okay, well, tone down your trading. We know you're successful. You'll be able to make this back. We can get and trading at the level you were, because now you don't have any money, so you need money, right? So then guys, they start making some money back, and now all of a sudden they're only down a few $1 million, and they're paying back their guys, and then all of a sudden they take another hit, and now they're back down $7 million, because they're still in that mindset of just, I got to get bigger and bigger to recoup what I had. That's the only way you can do it fast. But everything is relative. It's just, you're just throwing more rocks into something that, instead of and like you said, if they would have only risked this at first, they wouldn't be in this mess in the first place, and that's what people don't, it's that math is something they don't pay attention to. And then when they get in that situation, instead of being rational and being like, okay, so how do I get myself out of this hole? Well, the first thing they think is like, okay, well, if I had this amount of money that got me into the hole, if I have 5 times that capital and I make money like I used to, well, I can remove that hole and I'll be up money. Well, that does make sense, but that doesn't mean it's going to work that way. All you're doing is trying to speed things up by taking on too much risk, and the market can only bear so much risk too for traders. You got to remember that the market doesn't care about you, but there's only so much room for buyers and sellers in any given direction, right?
Yeah. And with leverage and trading, clients can go into the market with, $10 million before they even realize it.
Mm-hmm.
And you open up 10 lots of 100,000. That's $1 million. You open up 100. That's
right.
$10 million at a given moment.
Right.
The amount of ups and downs in that it's astronomical. And
sure.
And clients can move markets.
Absolutely.
One thing I've learned from the FX markets is that the world, despite it being such a big place with trillions of dollars being traded on a daily basis, a few $billion can leveraged can easily move the markets throughout the day. And individual traders can't, with leverage, they can do that with
Absolutely.
the right size account. So it can happen anywhere.
Mm-hmm.
All right. Aladdin FX have been making you wait for quite a while so let's ask you a question.
Okay.
How do you deal with fake and sensationalist news on daily trading?
Fake and sensationalist news. Okay. Well, that's actually comes over time. I remember when I was a boy, my grandparents and my parents always said, don't believe everything you read or what you see on TV. And anyone that's around today, doesn't matter what side you're on, knows that things are very cloudy and can be. And the biggest problem is that in the short run, if you have no experience in something, no matter how much you study it, it's like anything. You don't, until you have experience and have gone through enough things, it's hard to see certain things and sift through what is truth and what is reality. As far as when it comes to market news, right off the bat, just like I said, the best indicator for the markets is look at the markets themselves. It doesn't matter if you are a guru or not, a novice starting today, or have been in the business as long as you or I have been. The markets are what they are, and people are going to have all their opinions and what have you. I would be careful with social media, and if you want to know who to listen to or who to kind of give a grain of salt to, you got to give it time. You have to look at what do they say over time. I remember back in the early 90s, there were a lot of quote unquote market pundits that put out a lot of services. And back then you didn't have all the, ability for people to be like, this guy is a scam, and people just to look it up and Google it and whatever. And they were basically, they'd send out, to 10,000, because they get lists of people who have, stock accounts or futures account, and they'd send out, here's my newsletter, and they give you one side, to half the list, and the other market side to the other half the list. Well, if you give 2 points of view, one of them will be right. So then, where you were wrong, people are like, this guy doesn't know what he's talking about. And these people are like, oh my God, they're a genius, so they would play that angle. See, those people do exist. So what you need to do is see what someone's track record is. Also look at where they come from. I have a lot of clients of mine that come to me, then they get, there's a lot of scams in the Forex markets. Back in the 90s, when I first started trading the FX markets, when they first were opened up to, because originally the FX markets were only in the interbank currency desk network. If you guys on the trading floor, they were in the futures pit and on that market. If you weren't on those phones, you weren't trading Forex. You had to go through a bank, So, and now you can do these things, So, and the whole direction of how you get these things done, it's when it comes to news is you just have to look over time, and also do your due diligence. If you're watching someone on YouTube, I tell people, look, do they have disclaimers? Like people come to me and they're like, well, I think I got scammed by this FX guru. I'm like, okay, well, did you do your due diligence? And did you look at did they have disclaimers? And they're like, well, what do you mean? I'm like, well, like, for instance, on my website, now I don't need a disclaimer on every single web page, but I do have at the bottom of every single web page is a disclaimer, just like there is a link on the whole site to my disclaimer from my site. On my YouTube, anytime I produce a YouTube video, there's a disclaimer that comes up on my YouTube channel, and even on links that I have with other sites. So this is a way that it gives me not just credibility, but I wouldn't be involved with, like, for instance, partner relationships that I had and have my links on their website and vice versa if I wasn't compliant. Now, if someone's compliant right off the bat, then that at least they're not out to scam you, because not that people can't or won't try, but you're less likely to, because right off the bat, that they're aware of it and they're doing business with companies that won't tolerate if they are. So that's how you find, like, your sources. Like, if you're just going on, Reddit and Tumblr and whatever, and you find somebody and you're following them, you still need to do time. Don't just see something on any given day and be like, oh, they're really bullish the euro, they're really bearish the pound. Well, who is this clown? You don't know. You have no idea what their rationale is. Are they really, like, there's a lot of, if you look on YouTube, there's some people that have put out, they have these, like, 250, 300,000 followers, but when you look at their content, it's all nonsense. There's no disclaimers on it. And then when you look at it and you find out, oh, this person's not even in business anymore. There's a reason why this was from 4 years ago. So don't be impressed with just the size. Make sure that you look at the transparency, that there are disclaimers. Look at who they do business with. Actually look them up. You look up my name. I'm on LinkedIn. I have a company profile. I'm a verified person. I exist. Like, you'd be surprised how many. I've looked on FX sites and look at the board of directors. How come not one person can you find their name anywhere on LinkedIn or in professional networks? Why would they be hiding their names? Well, it's not because they're not hiding their names. Those are false pictures and false names. Those people don't exist, So, and I've encountered that too, So you have to be careful, and you have to look at where you're getting your information, Like, don't just follow somebody on Twitter because they have 500,000 followers. That just means they did a lot of promotions. You can buy followings, you can buy views, you can put up a perception, like, for instance, my business is built organic, people can look at the exchanges I've done webinars with, the brokerage houses, you can be over time and be like, okay, this is where this content comes from. And it's not all sales pitch like, oh, here, watch this video, I'm going to teach you how to make 100% return a month, and then there's the numbers too. You look at a lot of the news sources and people that speak on different, chat rooms and whatever, these returns are crazy, like, I've had people, I can't mention a name, obviously. A customer came to me over the summer, and he had met someone in Florida who he gave money to, and he said he met with me, and he's like, is it possible for someone on any given day to say they know exactly when to get long or short, say the British pound or the euro or whatever at X time, and then they make money 100% of the time? I'm like, that's absolutely impossible. It's absolutely impossible. You can't tell me that someone knows today that at 10 a.m. on Thursday, they're going to get long the pound US dollar for 20 minutes and make a profit no matter what, and be right 100% of the time. You know what I mean? Like, that's just,
they might have the DeLorean or something, but.
Yeah, exactly. Like, unless you're in a fantasy. Yeah, exactly. Or that's why I even told them, like, there's only two ways that's possible. Either it's God because he knows or whatever, or you're dealing with a time traveler. So to get to your DeLorean, yes, you're dealing with a time traveler. I'm like, these are the only two ways it's possible. Otherwise, no. So
you can't hit him unless you're like, looking backwards. Look at the chart. I called these ups and downs.
Sure.
What are you going to call the next one? Where's the next one going though?
Exactly.
Well, you're definitely hitting on a pain point with all the scams that are going on. They're getting more and more and more and more sophisticated. I've been getting reached out to on LinkedIn probably by a few different individuals saying, "Do you know this company? Your picture is on their website and your name." I was like, "We're talking with a number of different ISPs, internet service providers, because they've copied our website and they're putting it out there." I guess we've done.
So
a
this
good
is
job with our
happening to
company in
you
building a
too.
brand.
I can relate. The same thing is happening to me and my company.
What they did was they created a crypto site.
Okay.
To deposit crypto there. They copied Kathy Wood's Instagram account. She has like almost like an astronomical amount of followers.
Sure.
And they've done a good job where they've probably bought or put on like almost 90,000 followers on their Kathy Wood crypto account. And then there's links taking them back to this site, and then that site has pictures of. They ripped off pictures of us from our site and our website, and it's right there. And I was like, wwhere are all these clients when we're putting our stuff out there? But
that's the same thing that I say. I tell everybody, I'm like, if these people would actually work for me, we'd both be making money. You wouldn't have to worry about running from the law, So, I mean, according to LinkedIn, I have over 200 and some employees that, well, I'll tell you what, they're not working for me, but supposedly they do around the world, so.
Yeah. Good old the age of the internet. Yeah, we're just finding that.
Absolutely.
In terms of, I guess, your book, High Probable Japanese Candlestick Patterns, what can someone look to learn from there and expect from when they check it out? I remember you had a promotion a month or two ago on Amazon, and I sent a few friends over for that, and they said they enjoyed the book. What can the audience expect?
Okay. Well, first of all, actually, there's going to be a hardcover version coming out soon. Amazon didn't do that originally, but now they're offering it. So I actually have a copy of the edit version right here. So soon to be released. So anyhow, my book, what I did is I demystified the Japanese candlestick pattern whole thing. I keep it really simple. I don't, if you want to get into how many Japanese candlestick patterns are out there, there's, gazillions of them, literally. But the reality is most of them occur maybe once in a lifetime that you'll see it in a market. Sometimes it may happen a couple times, and then there's how reliable are they, so all kinds of patterns happen all the time. What I did was I broke down the most used and not just common. Some of them are common because, yes, they just happen to work that often. And what I did was I demystified how you utilize these things. One of the things I noticed, and I've been using Japanese candlestick patterns since the 90s, early 90s. Everyone's most likely familiar with Steve Nissan. He wrote, he's one of the quote unquote biggest names in the Japanese candlestick pattern writing sector, if you will. But before he came to market, everyone says he brought it to the United States. Well, it really wasn't the case. There was actually a Japanese author that wrote a book that was one of the first ones here that came in the 80s. And I read that book back in 1990. And then I read Steve Nissan's book, which had come out a little bit of time after that. And I noticed that the Japanese one gave a lot of history, but was really, really, really deep. Like if you had a technical analysis background, you could probably drudge through it. But you'd have to sift through all the stuff that's, history and blah, 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 that you just don't need to get to. It takes forever to put the meat and potatoes together. Steve Nissan does a great job of breaking down patterns and highlighting them and what have you. But one thing that he didn't do that did stick out with me with the other one was that they don't work on small time frames. Like I remember when especially when people first started making the migration to the floor. Like when I first got into the industry, everyone had bar charts. Within a few years, candlestick patterns started to be the quote unquote way that you look at a chart. Visually, it's easier to see, the highs and lows, up and down days. That's pretty easy. And then as far as patterns, I noticed that it doesn't work, intraday. You can't be on a 1 minute, a 5 minute, a 10 minute, a 15 minute because there's too much noise, and especially with the advent of electronic trading. electronic trading allows for a lot of over trading. You get big erroneous swings because of lapse in volume. So you get these gaps that you wouldn't, or not gaps, but spikes that you normally wouldn't see if, for instance, it was a pit trade, because you would have more liquidity at levels. You wouldn't have the ability to have these vacuum pockets, if you will. But on a daily basis and weekly and monthly, that's a totally different story, and even hourly basis, but mostly from the daily on, that is something you can count on for these patterns, and especially because when you put them into relationship with trends, a lot of trends in currency markets, futures markets, stock markets, they begin or end with these patterns. So, and I noticed that more and more and more, and it's not about trying to pick tops and bottoms, because I tell everybody, never try and pick a top or a bottom. But it doesn't mean you don't try and find a time to sell or to buy. Because remember, when we started this conversation today, you need to know what your entry point is to begin with. So you need to have a reason. So my whole thing is, when I started doing was, I would look at indicators, and I said the markets are the best indicators. So when I have my view of the markets, and then I have other indicators that line up with a high probable Japanese candlestick pattern, then I know that I'm putting myself in the best situation to either join in, rejoin a trend, which means trade the action, or I can either put on a counter trend trade. Now, when I put on a counter trend trade, that's and I have my position on, and I have another signal that comes on. If all of a sudden a high probable Japanese candlestick sell pattern comes in when I'm long, that smaller position, I'll take that one off and not try, and I won't even figure out whether it may still go to my profit objective and that second signal is wrong or not. I would get out of that one. Would I liquidate my longer term one? No, because that is still with the trend. Okay, so now, or I may look to take profits if it's like, for instance, let's say I have this objective of 116 in the US dollar yen. If all of a sudden we're at 115.40, 115.50, 60, something like that, and you're only a half a dollar away from your ultimate trend objective, and then all of a sudden I get one of these sell signals, well, then I would probably liquidate my whole long-term position, even though because pigs get fat, hogs get slaughtered. If I'm right in front of my profit objective, and then all of a sudden I do have something that normally I would execute a sell signal on, I'm not going to wait to see if this is just a short-term sell, come down a little bit, and then bounce, and then go maybe up to my original profit objective, because that may occur. Anything can happen. Or my profit objective may have been too high. You never know. That could be a scenario too, in which case you don't want to get chopped up. So the book mostly specifies on how to trade on the daily, weekly, and monthly basis, a little bit with the hourly, and it gets into why you can't trade the intraday, and then when you apply, these patterns, and especially with good money management rules. And that's the thing is like, for instance, recently there was a trade where there was some corrections in certain currency crosses, and then all of a sudden there was a couple bullish engulfing lines and a couple piercing lines that all of a sudden these are now going back with the trend. So these are things that when that happens, as long as, then you have your money management. So that's when I look to put on those trades based off of, okay, where's my account at? Where's my long-term position? This is an add-on. What is my risk? Figure out those numbers and then go from there, but it's very important that you incorporate these things too, like when you have a buy or sell pattern, you have to have an expectation. Like, could it be the low for the next 6 to 12 months in the market when you activate on one of these buy patterns, for instance? It could be. It could also be just a short-term signal that lasts for 3 to 5 days, so you don't necessarily, depending on the situation, you'd look either to ride a trend, but you never try and just pick a bottom or top of the trend ultimately, but you manage those in there. And then also I have a whole chapter that's dedicated to money management, which gets into just like your scenario about, if you've lost 90%, how much of a return do you need to make to get back to even? And I get into that, and it's kind of funny with FX, with the power of leverage. Coming from the futures background, leverage is something I was totally familiar with to begin with, and I understand it. Most people that just start getting into FX, I tell them right away, I ask them, I'm like, so what markets are you trading? And some people, now depending on what part of the world you're in, you have a reason why you may want to trade a certain cross. But I always tell them, especially starting out, trade the most liquid, and also be careful of the margins. When I first started trading, let alone trading currencies, the margins were 1/5 of what they are now, for contracts. I mean, with the volatility we have and stuff like that, it's understandable why we have this. So, and I tell people, have a rational expectation. Like, I know people that will put $5,000, $10,000, $20,000 into an account, and they're trading at a level as if they had $200,000 in their account. So if you're doing that, you can never be wrong, because once you're wrong, you're gonna just destroy your account very quickly. It doesn't take many wrong trades to all of a sudden lose a majority of your capital. And then as your capital diminishes, obviously, and margins are high, then you have to cut back your trading. So you have to trade with less and trade less contracts to try and make back what you lost with more contracts, so you're constantly becoming a hamster on a wheel. And my book really highlights how to avoid that. I mean, nothing's for certain in life, and nothing's 100%, but you can put the odds in your favor. And trading, and this is whatever conversation we have today and whatever your viewers get out of it, I would tell people that, besides the fact that trading is a business and you need to treat it that way, you really need to keep things in perspective. Like I know people, and like, okay, well, let's say, how much money do you think you want to make in a year? And I'd say, well, what kind of return do you think you can make? I mean, my expectations are much different coming from the floor in my experience than what other people should be. I tell people, like, for the average investor, I mean, I know people are used to making 30% returns over the past, 15, 20 years in many equities and stuff. But that's not rational. If you're just an investor, you should be making somewhere between 8 and 15% tops. 12% would be a good year. Anything beyond that, you should already start taking some profits, or at least expect to see, have a couple of years where you're not making that. And that's as an investor.
Isn't it the rule of 7? If you can get 7% for 7 years, you've doubled your money?
No, it's the rule of 72. You divide your interest rate by 72, and then it'll tell you how long it takes you to double your money. So, which that's another thing too. Some people should know that rule, because that gives you an idea of how much you got to make to grow your accounts. And this gets back to, now let's get your expectations. So you're not an investor, but you're a beginning trader. For you to think that you're going to make 100% on your account in a year, a lot of people think, well, within a leveraged thing, you can do that. Oh, absolutely you can. But it's how you make that, and most people, like I said earlier, they'll trade an account way beyond its level. So they'll never make that 100% because of the way they're trading. Or they may make that 100%, but then once they make that 100%, then they'll blow it all out. They'll still lose it no matter what. Okay? So you have to grow with the expectations of, what am I capable of truly making? So when you have your capital, if you have 20 grand, for instance, in your account, most people would probably have 3 to 5 contracts on and have their whole account leveraged. You can't do that. You shouldn't do that. If you do that, odds are you're going to, if you pull through it and become successful, you're going to have a lot of hard knocks along the way. It's just your ability and stress levels. Like, you can make, let's say you're starting in the business, or you want to figure out how to get yourself out of your hole. I would say give yourself a rational expectation of trying to make, say, 10% on your account in a month. People say, well, that's not that much money. If I have $20,000, I can't live off of $2,000 a month. And well, okay, well, if you need to live off of your trading account, you need to have a really huge trading account, and then make sure that you really are only trading a very, very small portion of it, because you're going to need to live off of that account. So either way, you're withdrawing a check, whether you're making money or not making money, and part of trading is, I tell people, I'm like, it's not getting into a market, it's getting out, and you shouldn't trade just to trade, and so you got to have your plan, and then the money management. So it gets back to, if you only have $20,000 in your account, you should probably be only trading, if you're trading the big contracts, not the little minis or anything. I'm talking about full euro US dollar or pound US dollar. You should only be trading 1 or 2 contracts at a time, period, in your account. And then you're only trading one. So you can't, if you're going to do that, then you might as well do it with some minis, so you could do a value of 1 full contract and then take profits if you have 2 profit objectives or what have you, and scale trade it that way. You can't, you just have to have that in proportion and do it properly, because especially when you look at the major liquid markets, if you're a pound trader, you're going to have more risk on any given day if that market moves than you will in most other currencies. Especially think about something like, I don't know, like the US Swiss cross on any given day, or the US Canada, and the margins are higher. So you need to have more at risk. So, some people say, I've heard people, they're like, I trade the British pound and I've been losing and losing and losing. I'm like, well, why are you trading the pound? Why don't you trade the euro? First of all, I'm like, the risk is not as high. The leverage is not as high, and the moves are not as severe. I'm like, when the euro has a big move, the pound has a monstrous move typically, if it's a true trend move in the currencies, and I don't care what like for instance, I have a pound Australian dollar cross going on right now. Gets back to the oil trade that I've been holding on for the past couple of months, so, but I have that, and that capital was allocated from the beginning of the trade, and that's that. There's no messing with it. There's just, you leave it alone, and that capital was allocated. And I don't add to it now just because the trend's moving, and I didn't put a bigger position on, because then that margin would be eating up and my risk level goes up, and remember how I told you, just like how I look for trades to place, I look for, at the very minimal, a 2 to 1, and that's usually like a short-term trade. We're talking like an hourly trade. But if it's a daily or a weekly trade, I'm definitely looking for 3 to 5 times on that, and if you incorporate those things, to help buffer your losses, which you're going to have. Anyone out there that thinks you're not going to lose, trading every once in a while, well, you're totally delusional. Even my signals aren't 100%, so I would never tell you they are. Are they high probable? Absolutely. Do they work very well? Absolutely. And they also work for, doesn't matter what market you're trading, like I tell people, just because, why do I look at all these markets? Well, because it also helps me know where other markets are going, and other opportunities, So for instance, there's times like I don't trade the currency futures that often, because I trade a lot of crosses that they don't offer, so I can't do the pound Australian dollar options or futures, so I do the Forex contract, but now there's times where, for instance, I may not want to put on a euro US dollar Forex position, but I may put on a euro US dollar option position or a futures position, based off of the same signals, and that's another thing where you can get a leg too, is there's a difference. That's the nice thing about, remember how we were talking about spreads? So you can trade the euro future and the euro currency. So there's times where, for instance, that there'll be a run, I'll get a buy signal in the euro currency, and the future is actually a little bit behind in the lag, so it's at a discount. So I'll actually buy the future and get long instead of the FX contract, because I know it has to catch up to the pricing of the cash contract. So I'm actually getting a chance to basically buy it better than I can in the FX market. Letting, once it comes back to around parity, or even, God forbid, it goes to a credit, then that helps even more for the position. So these are things that I look for in that kind of a thing. But it also still gets back to how much money is in my account, how much am I risking on my trade, and never risk. I put it in my book. If you have 5% of your account at risk on any trade at once, then you are way overboard. You shouldn't be more than that. 2 to 3% is really where you should be. And that means that, sorry to say, you have $10,000, $5,000 in your account. Well, you're not trading the full contracts. You're trading minis. And then you're going to say, well, but I'm only going to make, 50, $100 a month or whatever in the beginning off of my account. Well, it's all relative. If you had $500,000 instead of $5,000, what would that $100 a month be? Same difference, but you have to trade, but you still have to keep it in those parameters.
Yeah. And we had, like, watching a family office trade, traders would be astonished at the little amount of leverage that they use, and they make 1 or 2% a month with hundreds of little trades that add up to it. So it's definitely important that you understand your risk and understand your tolerance and how to place those trades, because it's easy to get stuck on a trade idea, and it's definitely really easy to over leverage yourself and just all of a sudden, like, watch your account dwindle away on a trade idea that, if you don't have a plan, if you don't have a plan, if you don't have proper risk management, it's just gonna go against you.
Yeah, the chapter on risk management in my book alone, forget high probable Japanese candlestick patterns, forget the methodology or a way to incorporate buy and trades, sell signals into your own systems, which you can do. The chapter on money management, it carries to all trading to begin with. It translates to business in general, but also to any markets that you trade, whether it's FX, stocks, commodities, options, it doesn't matter. That chapter is worth reading to anybody. I know people who have been in the industry as long as me and longer that I showed my book to and stuff, and they all said, they're like, the money management chapter, like, that's huge. Like, that alone could be the price of the book. The rest, the other, you could have all blank chapters. Just that one chapter in those pages, that is worth more than the price of the book. The knowledge and the fusion of all these things, like when I was in the trading floor, I know we're getting close to the end, we used to have, trading cards and sometimes have some rules like the 10 rules of traders, always get out of a loser, blah, 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 just these are things you just always do when you're on the trading floor, and the list, it grows, and it grows and it grows. But these are the things that give you longevity. These routines and these things, sometimes it sounds really crazy and like, oh, well, you've always been saying you got to do this, you got to do this. It gets back to fundamentals. It's like if you're a baseball player, a hockey player, I grew up playing hockey and golf, and baseball and stuff. And then it doesn't matter whether you're a basketball player, at whatever level you are at your game, you always practice the fundamentals. What happens when you don't follow the fundamentals? You lose the game. Errors happen. All of a sudden, you're no longer a superstar. And trading, I hate to tell you, it's the Stanley Cup, Super Bowl, you name it, every single day. And one other thing I can give you is advice that, when I first got in the business, one of the traders that I worked for, he was an older guy. He was already retired technically. He was in his 60s and still coming down there every day, And I'm like, hey, Benny, so what really do you think is one of the key things that I need to remember always about trading so that I'm still here at your age? And he's like, you know what, Teddy? He's like, whether I'm here today or you're here today or tomorrow, these markets, he's like, maybe not this building, but the markets, he's like, they're going to be here every day, at least 5 days a week. It's like, the question is, are you going to be? He's like, you've been here long enough. You've seen enough people come and go, and you're going to see a lot more people come and go. The people who don't follow the fundamentals, who break the rules of trading, they come and go, and that's just the way it is. The ones who are the discipline to stay are the ones that don't get too greedy. They know they have to. I mean, especially as a guy, it can be tough. You got to be like, hey, you got to know what your limitations are, and that's very important. And whether it's your trading account, what your limitations are.
Is that a Clint Eastwood statement? Clint Eastwood, right?
Yeah, right. Yeah, exactly. Yeah, it is. You got to know. It's right. It is a Clint Eastwood statement. A man's got to know his limitations. That's right. So that's that.
Well, Dan, we didn't even get to
the avant-garde.
What's going on with the news? But no, it's been a great hour, great time chatting. Do you want to leave us with some final words about Forex Trading Unlocked or
sure, absolutely. Forex-trading-unlocked.com. That's my website. It's not like your typical FX site. You're not bombarded with all kinds of pop-ups and pressing promotions and sales. As you pick through it, there's all kinds of useful information and access to data and charts and news and what have you. And obviously my YouTube channel and videos. A lot of times I stream almost every day. I stream live signals into it. Sometimes it's off for a couple hours, depending on if we're like right now, since we're doing this, there's no live stream going through the site. I started my site as a tool for me. I use it wherever I am, so I don't have to necessarily log into my accounts to check out the markets and stuff like that. So it's a great tool. And also you get access to me, and on my YouTube channel or Twitch, I do webinars and stream weekly stuff that they can get information that is dedicated to the Forex markets, and I also give the correlations like we talked about today. Like, I don't just say, hey, I'm bullish to US dollar yen. Well, so I give you a reason. I tell you about the oil trade, the interest rate trade, the reinforcements, the things that the moving parts that actually put these things together that you don't get anywhere else, that you just don't get. So, and I actually changed when I broadcast, like I do a weekly thing. And I used to do stuff in the morning, but there's a couple people in our industry that I noticed, well, how come after I do mine, all of a sudden something I said, like when I was talking about $100 oil back in January and December already, and one of the talk shows I go on every Wednesday, I'm not going to mention their name, every week they're like, we're already at almost $80. We're like, we still going to 100? I'm like, oh, we're going to 100. I'm like, unless you remove an executive order, which that's not happening anytime soon. So, and these are things that you'll get from me through Forex Trading Unlocked, that's for sure. So.
Awesome. Teddy, I want to thank you for joining. We definitely have to do this again. I feel like there's much more to talk about. We've only scratched the surface.
Absolutely. Thank you, guys. No, this was a wonderful hour. I thought great conversation. Absolutely. I hope your viewers enjoyed it, and I hope the people, the questions that were asked were answered to their satisfaction.
Yeah. Excellent. Well, thank you. Let's do it again. The audience, I want to thank you for checking us out. All right. Thanks, everyone.
All right. Take care.